My oh my, what a way to wrap up what has already been an extraordinary month of January in the US stock market. S&P 500 was up 1.5% today. That means that we're up 6% already on a year-to-date basis. There's only been a handful of times throughout history where the month of January has been up over 5% and the prior 12-month return is negative, and in all of the prior instances, it basically kicked off a massive bullish run from that point forward. So we'll see if maybe we can get lucky once again with that as we move forward from here. But there's a lot of bullishness out there. We're going to take a look at sector rotation in tonight's video and show you how all of the exact sectors that we want to be doing the best are doing the best, and how the ones that we prefer to do the worst are doing the worst. We're going to take a look at some of the different asset classes out there, some of the more speculative ones, try to get a sense as to what's been happening with those recently, and then we'll get into our trade application example where I wanted to take a look at a less directional type of a trade, knowing that tomorrow is the FOMC announcement, trying to play it a little bit safer and doing what's known as an iron condor on a big consulting company. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's January 31st, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area and make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. And remember, at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at the web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And my, oh my, that's what you want to see if you're bullish in the markets right now. Green as far as the eye can see. This was one of the more overwhelming bullish days that you can experience. Obviously, it's not 100% green. There are a handful of red squares and rectangles in there, largely because we're in the heart of earnings season right now. So most of those that you see in the red are folks, or not folks, but companies that reported their earnings, and the market wasn't too keen upon what they read out of them. So those stocks include McDonald's was down about 1.3% today. Phillips 66 was down almost 6% today. Caterpillar was down 3.5% today. Corning was down just over 4% today. We had Micron down over 2% today. Moderna was down 2%. NextEra Energy was down 0.5%. Cisco Foods was down about 1%. Even Chevron was down just barely, but down a little bit here today. So it was a little bit sporadic. I see GE down a little bit there as well. There really weren't a whole lot of stocks that were down. Most of them were earnings related. This, as most of you are aware, at least if you follow David and I on Twitter, you're aware that this is basically the biggest week for earnings that we will experience during this expiration, or not expiration cycle, but earnings cycle that we're going through. In other words, from a market cap perspective, you have the most amount of market cap reporting their earnings here this week. So anyway, pretty interesting to see that pretty much the only stocks that were down today were directly as a result of earnings. Otherwise, if you didn't report earnings today, there is a very, very good chance that your stock was up. Some of you might be looking at your portfolios today and finding that next to all of your stocks were up today. Remember that happens occasionally. Sometimes it happens the opposite way too, right? Sometimes on really terrible sell-off days, all of your stocks are down. But today is one of those days where a handful of you out there listening right now will probably look at your portfolio and see that basically every single stock was up. That was not the case for me, unfortunately, as I've been kind of bemoaning here over the last few weeks. Dividend stocks have not held up quite as well in 2023 as they did, at least on a relative basis, in 2022. This year has been more of a sign of immense rallying out of stocks that were really beaten up last year. And since dividend stocks held in there reasonably well last year, they're not the ones that are rallying the most furiously this year. Now, there's, of course, exceptions to that rule as well. But in general, this year has felt more like very much a risk-on mindset. Once again, chasing some of those growth stocks and those innovative, disruptive types of companies. Tesla, of course, comes to mind. Speaking of which, you can see Tesla was up yet again today, up about 4% there. Amazon was up 2.5%. GM had a great day. They were up 8% today, one of the bigger movers in the S&P 500 today. But really, it's kind of hard to pick and choose the big winners. We did have UPS. That's, of course, a nice dividend name there that we talk about quite a bit in my classes. Today, by the way, I taught my dividend growth investing class this morning where we concentrated on the communication services sector to get some new exposure to our portfolio. But UPS is a name that we're no strangers to. They reported earnings and ended up being up about 4.5%. Of course, FedEx was up in sympathy, up about 5% here today. But again, it's kind of hard to pick and choose on the green side today because there's just so many. I mean, throw a dart at this, and you're probably going to end up having that dart land on a pretty nice return for you here today. So this was a great day, especially for those of you that have longer term portfolios dedicated to the long side of the market. Now, of course, the question is, how long can this last? Because we all know that the big day is tomorrow, or at least one of the big days is tomorrow, with Federal Reserve meeting. Actually kicked off today, but the interest rate announcement itself will be tomorrow at around 2 p.m. Eastern time. Right now, the market is widely expecting a 25 basis point hike, but sometimes the Federal Reserve likes to shake things up. So until it actually comes out, we won't know for sure. But I would be personally surprised if the Fed chose this moment to add a shock into the system. Then again, because the markets have been roaring so much higher, including recoveries in Bitcoin and housing and other financial assets out there, you just never know. Maybe the Fed is saying, you know what, we didn't want to have to do this, but you guys are making it hard on us, and we got to get this inflation under control. So we got to talk tough here. I would be again surprised if that happens, but I wouldn't be surprised as much if they would raise the interest rates 25 basis points and then talked really tough in the conference afterwards, right, when Chairman Powell gets addressed by the reporters. So we'll see if maybe that creates a little bit of volatility on an intraday basis tomorrow. Let's go ahead and take a look at our actual breadth numbers here today. And you can see it was a runaway freight train. I mean, again, you have a very good chance of opening up your brokerage statement tonight and having a very big smile on your face. Out of the 500 stocks in the S&P 500, 469 of them were in the green today. That's good for about a 94% hit rate to the upside. So anyway, unless you had one of those stinkers that reported earnings that the market didn't like here today, you're probably sitting on some nice profits to the upside in your longer term portfolios. Let's talk about some earnings here this afternoon as well, because there were a number of stocks that just reported here within the last hour or so since the market closed. So sometimes it's fun to roll through those to give you a sense as to what to expect when we open up trading the following day. Let's come over here to the trade tab. Oh, I just posted about this on Twitter as well. Some of you may be familiar with Scott's Miracle-Gro. It's been quite the controversial name over time, but some of you know that I've traded or I've sold puts on Scott's Miracle-Gro on a couple of occasions last year in this very Market Outlook YouTube presentation for our trade application examples. And it's so interesting because last fall, I remember scurrying to continually roll those puts because they were constantly getting rolled over, or we were getting rolled over in the trade. In other words, we wanted the stock to stabilize, and it just kept on going lower and lower and lower. So I kept on kicking the can down the road, rolling those sold puts, collecting a credit in most cases, and improving our eventual cost basis. But I just happened to notice that it was rallying furiously right alongside the rest of the market today, up about 9%. And I was like, well, wait a second, hasn't it already been rallying quite a bit this year? I went to the chart and I was absolutely flabbergasted. Let me right click here. To put this into perspective, when I pulled up Scotts Miracle-Gro's chart and I see that it's basically up 48% on a year-to-date basis, or if you were to look at a 1 month look back and include like the last trading day of last year to where we're at right now, it's basically a 50% move. So this kind of gives you a sense as to risk appetite being back. In fact, some of you might have seen my other tweet earlier today on the cover of the Wall Street Journal on the final trading day of last year, and how the tone of the front page of the Wall Street Journal is tremendously different than the way that most market participants are interpreting our current situation here just 1 month later. So it is quite remarkable what 1 month can do, not only to an individual stock like Scotts Miracle-Gro, where it's now up 50% in a month, but even just for the entire stock market. I think the mood is much more buoyant right now than it was a month ago. And so a lot of good things lining up there from a breadth perspective, as we've talked about before with the January barometer and some of these other indicators out there that suggest these are good signs as we move forward. So anyway, I thought that was quite interesting, to say the least, that Scotts Miracle-Gro was rolling over so hard. I was scurrying to roll those sold puts as fast as I could last fall, and now it's almost like the exact opposite. The stock is just screaming higher that you're having a hard time keeping up with it on the upside. So it's been wild to say the least with a number of stocks. Anyway, let's talk about some of the companies that are reporting earnings after hours here tonight. Amgen is on the list. So Amgen is a stock, of course, that we talk about a lot in my dividend growth investing classes. In fact, we talked a little bit about it here earlier today. We didn't have a formal head-to-head matchup on it, but it came up when we were looking through some holdings of some other outside dividend newsletters out there and kind of comparing it to how we would approach it as a dividend stock here at Market Scholars. And it was down a touch after reporting earnings, but it really has kind of vaulted back to about the break-even point. So it touched as low as 243 in the after-hours session. You'll notice up here that it closed at 252, so it went down about $8 or $9 per share. This is a pretty high-price stock, so that's not a huge percentage. Nonetheless, it went down about $8 or $9 per share, but has now rallied all the way back, and you can see that the bid and the ask is just a hair above 251 right now. So when it was all said and done, this stock is down a whopping $1 per share after hours. So not a big mover there in the case of Amgen. Some of you saw me tweeting about Amgen earlier today. They'll actually start eating into AbbVie's lunch here with their biosimilar drug that they have that is now going to be used as a generic comparison to the world's best-selling pharmaceutical, Humira, which of course is owned by dividend aristocrat AbbVie. And so that cash cow era that AbbVie has had for the last decade or so may be giving way a little bit as some of these biosimilars start to eat into some of those immense cash flows that AbbVie has had over the years. Anyway, let's take a look at another stock reporting earnings after hours. This one I was joking about on Twitter as well, for those of you that follow me there, because I said, here we go again, just like clockwork, Snap is snapping. This, of course, is the social media company, and I don't personally use it here, but I know a lot of the younger folks, or at least that's my understanding, do, so there's plenty of people that do use it, but it is one stock that I've noticed over time that constantly has massive movements after hours, and here we go yet again. It ended the day at $11.56. It's currently trading below $10. And remember, on a small price stock like this, as opposed to Amgen, that is a huge move. In fact, I'll show you what I was referencing on Twitter when I said, just like clockwork, here we go again, Snap, and show that it's down 13% after hours here today. And I quote retweeted my quote from back in October when I said, laugh out loud, it's uncanny. Has there ever been another stock so snapped after earnings, after reporting earnings so consistently as Snap itself? Of course, that's the ticker symbol. And I showed some of these other times that I had tweeted about it. And that's why it came to my mind, because I feel like every time that Snap is reporting their earnings, I think the exact same thing in my head. And here I was tweeting about it in 2017 and 2021 and 2022, and it's constantly like snapping a pencil. Well, here we go again. It appears that, yes, indeed, we are snapping that pencil on Snap once again. It's not quite as bad as some of those others. Some of those others were down like 20%. This is only down 13%, but that is still a pretty healthy haircut to people who might be involved in that name. So that one's not doing us any favors out there in the social media world at the moment. Another big company that reported here tonight was AMD, and that is a very important player in the semiconductor world. Of course, we heard from Intel last week, which was highly disappointing. Here, it looks like the market is much more accommodative towards their arch rival AMD, or Advanced Micro Devices, release, and the stock is up a couple of bucks after hours. Not a huge move, nonetheless. At least it's not a disaster like Snap was. This one is trading at 77 after hours. It closed at close to 75, so up $2 per share. Mondelez, of course, the Oreo cookie company that comes up quite often in my dividend growth investing classes as well. This is the company that was spun off from Kraft all of those years ago. This is basically Kraft's snacking division, is the way that you can kind of think about that, where they have a lot of their cookies and chocolate and things like that. Anyway, it's doing pretty well after hours. At least that's what it appears to me. They ended the day at 65.44. They're currently trading about $1 per share higher than that. And remember, for a boring consumer staple company like this, that's actually a pretty good response, all things considered. So no major blow-ups in the case of the Oreo cookie here tonight. Let's see what else is out there reporting earnings tonight. How about Electronic Arts? This is, of course, a video game company, one of the largest on planet Earth, and they are suffering here after hours tonight. They closed just under 129 here at the normal session, and right now they're trading at about 120 after hours. So they're down about $9 per share after hours here. So looks like not such a great time there in the video game industry. Edwards Lifesciences is another company that reported earnings tonight. They ended this session at $76.70. Looks like they're up a couple of bucks after hours, so I guess it's kind of similar to AMD in that regard. Nice to see that they didn't implode, but it's not a huge move to the upside at the same time. Chubb also came out with their earnings here tonight. This is one of the most quietly successful companies that I've ever encountered. Those of you that are in my dividend growth investing class will recall that we bought Chubb in 2020, less than 3 years ago, at exactly $100 per share. It was at that $100 per share where it was yielding 3%. Fast forward to where we're at right now, less than 3 years later, and you can see the yield is half of 3%, only 1.46%, and of course the stock price is more than double of what it was at that time. Yet I hardly hear anybody ever talk about this one. It's kind of remarkable, and it's kind of the way I like it, quite frankly. With the stocks that I own, I don't want it to be a stock that has a lot of buzz and collects a lot of the wrong types of shareholders, because those are the ones that will leave very quickly as well. So in a way, I kind of like these sneaky, quiet types of companies like this dividend aristocrat here, Chubb, which for those of you that aren't familiar with it, it's a property casualty insurance company that caters to kind of a higher end clientele, particularly out on the East Coast. But looks like they are basically hanging in there after hours. Not a lot of activity on this one as a boring insurance company. It closed the day at 227. It's trading probably about 225 or 226 after hours. So again, pretty much a meh report there in terms of a reaction from Wall Street. Stryker also reported earnings here tonight. And Stryker is actually doing pretty well, it looks like. They closed at 253, so this is a medical company. A lot of hip implants and that sort of thing is the way that you can think of them. And they are up trading at close to 265 in the after-hours session right now. So looks like up about $10 to $12 per share after hours for that healthcare company. And then last but not least, there was a smaller company that reported earnings here as well, Super Micro Computer, SMCI, and you can see that stock is down quite a bit after hours on a percentage basis. It closed at $72 here today and is currently trading a touch under 65 after hours. So if I had to judge, based upon those key economic or earnings reports that we just rattled through right there, I would say it probably leans a little bit more bearishly, with the big story kind of being Snap to the downside. But it wasn't a disaster either. So I don't think we'll go into tomorrow with some huge gap down for the overall market or anything like that. I think we're kind of in a holding position for the market at large as we kind of await what will happen or what will be said with the Federal Reserve interest rate decision. So we'll find that out very shortly. All right, let's get back on track now with kind of our typical routine. Try to get a sense of what's been going on with the broad markets. And of course, if you've been listening to these market outlook videos, it shouldn't come as a big surprise to you, but just to make sure we're all on the same page, we've had bullish postures for quite some time across all four of these indices here. You can see that it was a huge day to the upside. As I mentioned before, 94% of the S&P 500 components closed in the green. So no surprise when you see these 1% plus types of moves across the board. So let's see what we can identify. The S&P 500 was up 1.46% here today. You can see by that candle that we basically closed at the high of the session. In fact, there was a nice little pop in just the last, I think, 15 minutes or so of the session itself. And so with the S&P 500, we are right up there at some of those areas that we were trading at maybe 2 months ago or so. You can see that we had a high candle there on December 1st. We had another high candle there on December 13th. That kind of represented a little bit of a double top at that particular time. And at this moment, we're just a hair below those breakout areas. However, there is one thing that could catch your eye, which is closing prices, right? When we look at this high label here, that's referencing an intraday price. But today, since we closed at the high of this enormous candle that we're dealing with here today, and this candle over here and this candle over here did not close at the highs, it's possible this is a new closing high. So what I want to do is I want to identify with this other big candle over here on November 30th what the closing price was there, and I can read that data up there. I know some of you watch this on your smartphones, and so you're not going to be able to see that as well as somebody who's watching it on a big screen, so I'll try to read that out to you. But basically the closing price on that candle right there was 4,080.11. And since we closed today at 4,076.60, we were just shy of a new multi-month closing high on the S&P 500 today. Just shy by 4 points. That's it. So it was awfully close, but this one back here on November 30th was still a touch higher than where we closed here today. I know that's hard to see with the naked eye, but as long as we trust that data that the Thinkorswim platform is giving us, which I do, then we know that to be the case. So we're right up in that territory where, depending upon how the stock market reacts to the Federal Reserve tomorrow, we could easily see a breakout on the S&P 500 to the upside. Then again, if you're tilted more bearishly in your thinking right now, you might also look at that and say, hey, maybe that's a resistance area, and maybe that's the excuse that the bears will have to push this market lower as long as they can't break through these prior highs over here. So a lot of it will, of course, be dictated by how Jerome Powell unveils his policy, what his expectations are moving forward, and how their battle against inflation is going. So right now, of course, we remain with bullish postures with the S&P 500. That's been the case for most of this year, right? We had this little brief kind of head fake right here in the middle where we had this pink area of the chart. But for the most part, this calendar year has had way more bullish posture days than bearish posture days. So the momentum is in the favor of the bulls right now. You'll also see that we have have the green line or the moving average, in this case the 30-day moving average, is colored green. And what that suggests is price is above a rising moving average, which is also another bullish feature from a technical analysis perspective. So strongly bullish intermediate posture with the green line on the market forecast in the upper reversal zone and price above a rising 30-day moving average. And so I don't have to repeat myself so much. Just be aware that's the case on all four of our charts, right? Dark green background on all four of the charts and green moving averages on all four of the charts. Now with the Dow, that actually just happened today. So at least that's something fresh or noteworthy that I can bring to your attention. Remember yesterday, the Dow had a yellow moving average. Today, it is now green. And the reason that happened is the moving average itself has started to turn higher. So even the bullish pressure in the Dow has been strong enough to basically bend that 30-day moving average up with the bullish price activity. But like is oftentimes the case when we have a roaring market to the upside or a roaring market to the downside, typically you do not find the Dow Jones to be the leader in that regard. We did have a moment in time late last year where that was the case, but we were pointing that out as being, rare and not the norm, right? What we experience today is the norm, where the big blue chip index was up nicely, up 1.09%, but it was actually the worst performer of all four of these charts. Again, like I mentioned earlier in this presentation, this year has not been a move into the high quality lumbering giants, captains of industry, bellwethers, blue chips, dividend aristocrats, that sort of thing like we saw so often last year. This has been closer to a dash for trash. And the stuff that got blasted the most last year is the stuff that is most likely to be up the most so far this year. And so the more speculative areas are up much more substantially than the Dow, not just today, but also on a year-to-date basis. You'll notice that the Dow, as a matter of fact, is only up 2.83% this year. So that's not that big of a move compared to the 6% move out of the S&P 500 year to date, the 10% move out of the NASDAQ year to date, and nearly a 10% move out of the Russell 2000 on a year to date. Those are some enormous numbers. Remember, throughout history, the average annualized return for the stock market is somewhere between 8 and 10%. So what we just witnessed from the NASDAQ and the Russell 2000 is equivalent to 12 months typically in the year, what we just experienced in this 1 month so far in 2023. So it's kind of interesting to think about the markets from that perspective as well, to kind of get a sense of how fast we've come. And of course, we have to take that into context that we were down significantly in those areas last year. So part of this is just kind of righting the ship. Nonetheless, it has been an extraordinary move so far in 2023. You can see that the NASDAQ was up 1.67% today, which was the second best performing index. The best performing index was the Russell 2000. It was up 2.45%. And remember, when I was with you last week and even the week before that, I was talking about how the Russell 2000 is this market's new leader. It's something that we've discovered in our factor selector class as well, or our factor-based swing trading class as well, where the low size factor has been the leading factor for the last 3 weeks. And that corresponds very well with the Russell 2000 at a broad index level, because this is chocked full of the smallest companies in the United States, or at least most of them. And so the Russell 2000 is proving its worth once again. We recognized it was a leader back here. It continues to be the leader today when it led all of the rest of these indices. And so it has been quite a breathtaking move for the small caps here in the United States. Notice that their intermediate line is at 93 right now in that label down below, which is better than the 88 over at the NASDAQ, better than the 85 over at the S&P 500, and better than the 66 over at the Dow Jones. So the Dow Jones went from being the leader at the end of last year when markets were still a bit dicey, to now being the actual laggard of all four of these early on in 2023. Of course, that could change if the sentiment on Wall Street changes tomorrow with Jerome Powell, or for any other reason. It's possible that could switch back. But for right now, this is a strong bullish sign out of the market. This is kind of the leadership that you want to see if you want to be bullish within these markets. Let's go ahead and now pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. As I always say, as long as we're up and over 100 likes on the pinned tweet, I'm more than happy to give you a full hour of a presentation that includes 12 grid analysis and a trade application example and extra goodies that we do. On the other hand, if you prefer the shorter version, like we did last week on one of the occasions, where you only want to hear from me for 15 minutes without the extras, then don't click like on Twitter. And if we're under 100 likes, then that will be a day when I just do a 15-minute quick hitter video. But since today was a day where we got well up and over 100, this is a full featured video here for us tonight. And so thank you to all of you that contributed to that, including Dennis and Keith and William and Dr. Bob and AC and Jim and Dean and Wayne, Leo, Das, Gary, Lucius, Brandon, Marty, John, Ram, Nikolai, David, Arth, Trunk, Sandeep, John, Margie, Albert, Fun Jonesy, Roger, Neil, Ruban, Roger, David, Randy, Kirkeye. Too many to go through all of them, but I appreciate each and every one of you taking the 5 seconds out of your day. Obviously, these presentations take a long time for David and I to put together. On average, it's about 3 hours is the amount of time that we need to commit to doing this completely free video that you find on YouTube. So the one trade-off that we ask out of you is simply support us with a free click. It doesn't cost you a penny. All you have to do is click a button and it'll only take you 5 seconds. So appreciate it, each and every one of you that helps us along with that. Let's also have a little chat here about some of the stuff on our website. Just wanted to remind you real quick, some of you know that I do this, some of you might not, so I'll use this as an opportunity to highlight it. I do what's known as the 9 at 9 every morning, and so a half an hour before the market opens, basically putting together some information for you as to which stocks are likely to be leading the market and which stocks are going to struggle in the market today. And so, today as an example, I talked about how General Motors ended up being up 8% at the end of the day. They were on the 9 at 9 before the market opened this morning, up 5% at the time when I highlighted this. And I know A.O. Smith went up tremendously today. It was on the positive side on the 9 at 9. That's a dividend aristocrat as well. It was actually up 13% today, but it was already giving us an indication before the market was open that it wanted to giddy up and get going there. And then same thing on the flip side, on the other side of the 9 at 9, the 9 losers pre-market, some of those were the ones that ended up doing poorly here today. I know I mentioned Moderna there a moment ago when we looked at the heat map as being one of the few stocks that was down today, and also McDonald's was another one that ended up being lower here today. And so we already knew that ahead of time on the 9 at 9. It doesn't always work that way, of course. Sometimes there's reversals and head fakes and things like that, but it can at least be a good way for you to kind of get an idea as to what to expect out of the market that day, a half an hour before the market even opens. And so you can find this on our website up here for free, and this is something that's available to all of you, whether you're a premium member of Market Scholars or not. You can find it by hovering your mouse over the blog tab and clicking on 9 at 9, or just follow me on Twitter. I always post it to Twitter in the morning as well. So either one of those ways will get you done from that regard, but it's especially important during this moment in time when we're going through so many earnings announcements, because there's going to be some big movers on both sides of the equation pretty much every single day here in the foreseeable future as a result of all those big earnings announcements on the upside and the downside. Let's also have a little bit of a chat here about the sector selector tool. For those of you that are premium members, you can find that under our tools tab, our premium tools tab, and just click on sector selector there. It's kind of associated with the stock selector tool as well, which is actually more of a full-fledged tool that will look at metrics on 1,000 different stocks and kind of let you know which ones are meeting our class rules for our top-down trend trading class. But anyway, this kind of guides some of our decisions at a high level when we want to apply top-down analysis. And as I was mentioning to my students on Monday morning during that class, this is kind of what you want to see out of the sector selector if you want to be bullish in the markets. In other words, if I had it my way and I could somehow wave a magic wand to have certain stocks do well, certain sectors do well and certain sectors do poorly, if I wanted a really robust market rally, then this is pretty much how it would be shaped up in my mind. In other words, the top three sectors would be the ones that I would want to be the top three sectors. Discretionary, communications, and technology is where you oftentimes get your kind of growth compounders. Remember, discretionary is something that I've been pointing out to you guys for quite a long time because I felt like the average person was not picking up on the fact that discretionary was strong. Everybody was so focused on Tesla and Amazon last year that they weren't recognizing that most of the other discretionary stocks were actually just roaring to the upside. So remember, as far back as December 2nd, consumer discretionary was already number one back then. We really didn't see the added benefit out of technology and communications back then. At that time, technology was ranked number 6 and communications was down here at number 9. But it was at least a heads up that the market had a little bit of a fighting spirit within it. And remember, at that time, back in the first week of December, people did not want to believe it. They had just been through the ringer of the stock market in 2022. And if you said anything bullish, they didn't want to hear it. They believed that the stock market was going to continue to just torpedo lower and lower and lower. Yet there were some evidence, some signs of evidence out there that bullish conditions were trying to be developed. And of course, we never know for certain what will happen. We look at the evidence at any given moment in time. But that was one thing looking back that was suggesting that, hey, there is some buying interest out of the most important areas out there. This sector selector, by the way, looks at things on an equal weighted basis, not a market cap weighted basis, as I alluded to so much when we were talking about this very thing with consumer discretionary back then, because I was talking about over and over the week after week that, hey, other people may not recognize this because they're so focused on the market cap weighted consumer discretionary where Tesla and Amazon rule the day, that they're not recognizing that the other retailers and other discretionary stocks are actually doing quite well. And so I'm not surprised to see them continuing to do well right now. And I am pleasantly surprised to see communications and technology joining them at the top. Remember, communications is where you're going to find your big internet companies like Google and Meta. You're also going to find some of the big telecom players like Verizon and AT&T in there. You're also going to find some of the big media companies like Comcast and Disney in there. So those are some important companies and areas that you'd like to see do well if you want to be bullish in the markets at any given moment in time. And then technology, of course, is where you're going to find Apple and Microsoft and so many of those other software-related companies. You're going to find some older school companies like Cisco and Oracle in there, but they do still have a lot of sway over the overall market. Remember, the technology sector from a market cap perspective is the most influential sector out there to the S&P 500. Of course, we've got Apple reporting their earnings here a little bit later this week. We heard from Microsoft last week. So anyway, this is a really good sign for the markets if you want to be bullish to see those important, those key areas from an equal weighted perspective ranking in the 1 through 3 position. And then on the flip side of that conversation, look at who is at the bottom 3. You have healthcare, utilities, and staples. And when you think about those 3 areas, what you should be thinking about is their defensive characteristics, right? Those are some of the most boring areas of the market that were doing quite well last year that are now doing quite poorly. So the tide has certainly changed. And that's the whole point of looking at this graphic and understanding sector rotation is knowing that things do change. And it's up to us to witness those changes and to perhaps in some cases change our approaches towards the market based upon that new knowledge that we're learning. And of course, that's exactly what we hope to accomplish in my Monday morning top-down trend trading class that many of you premium members attend. So anyway, I found that to be very fascinating that we have the growth compounding sectors at the top, we have the clearly defensive sectors at the bottom, and that's pretty much what you want to see if you want to have a big ambitious bull market rally type of a thing, on the horizon. And, things will change and there's no guarantee that continues. But as of right now, factually speaking, these are the types of things that you'd like to see. This represents more fertile breeding grounds for a potential bullish move moving forward, as long as the Fed doesn't go and mess it all up tomorrow. So we'll find out about that. All right, let's go ahead, get back on track with some of the charts. And just a reminder, I taught my dividend growth investing class earlier today. You can find that on the class calendar up here under the trading rooms tab. And then David taught his directional option strategies class. Tomorrow I'll be teaching factor-based swing trading first thing in the morning. And then David will be teaching options inventory. So lots of great stuff on the horizon for you guys as well. All right, let's get back on track with the charts and let's do some 12 grid analysis now. And we'll start off with chart 5A here. This is our asset class 12 grid. And as we pull this up here, you can see a lot of green on the screen. The one that stands out from kind of a pink perspective is the one in the lower left-hand corner, and that's the US dollar. And as has been the case for pretty much a full 3 months at this point, the US dollar has been in a house of pain, which, remember, was not the case for most of 2022. For most of 2022 is the exact opposite, where the US dollar was rallying hard, which is what was putting a lid on any attempted rally out of the stock market. But starting back here at around the first week of November, everything changed. The US dollar started going lower and gold started rallying in response to a falling US dollar because, of course, gold is priced in US dollars. And we saw these big breakout moves in EFA, which is the developed stock market, foreign developed stock markets, and then also EEM, which is the emerging foreign stock markets. Both of those just took off. So notice the differences in kind of some of the return numbers. Notice that the US dollar, the UUP, which is basically the US dollar versus a basket of other currencies out there, with the euro being the most important, is down 8%. That's what that number in the red down there says. It's minus 8.39%. Notice that in response to a falling US dollar, gold is up 18.1% during that exact same time period. Developed foreign stocks are up 20.64% during that time period, and emerging markets are up nearly an identical 20.97% during that time period. Now notice the US market didn't fare too bad. It was up, but it was only up 5%. So that's, a good educational takeaway. Of course, it's always hard to predict exactly when these pivots are going to happen, but I think we've done a good job explaining to you over the years. Remember, David and I have been doing these videos and the predecessor video when we were back at TD Ameritrade for probably about a decade at this point. So most of you should be well aware of this by now. But in case you're newer to the video, when the US dollar struggles, what you should be thinking in your head is, how can I take advantage of that? One of the things that you might be thinking in your head is, is a commodity like gold a way to play that? Is a foreign market a way to play that from a stock perspective? If that's the way that you were thinking 3 months ago, you should have a big smile on your face right now, whether you piled into gold or whether you piled into foreign stocks. Either one of those would have been a brilliant move. Even if you just stuck with the United States, you still did pretty well. But you could have done a little bit better in some of those other areas that are more directly associated with currencies, like I just explained there. So anyway, US dollar does remain with a strongly bearish posture at this moment in time. It was down again today, about 0.22%. And as you can see, it remains below a falling 30-day moving average, which has been the case for nearly every single day for the last 3 months for the US dollar. So that has been one of the more consistent trending lower moves that you'll ever see. In terms of other areas that have pink charts, these other two, foreign bonds and oil, have pink charts, but notice the shading is lighter than the shading on the US dollar. And what that means is those are giving us weakly bearish conditions as opposed to strongly bearish conditions like the US dollar. So in other words, they're kind of in a transition point where you don't want to call them outright bearish yet, but they're starting to give a little bit of wear and tear on their charts where it's giving you a heads up that things are struggling a little bit more there. So foreign bonds were actually up 0.29% today, but as you can see, they've kind of slunk down a little bit more so than what we've seen with the US bond market. With TLT to the left over here, notice that we've had mostly sideways trading in US government bonds, and we've had mostly sideways trading in high yield junk bonds here in the United States. But foreign bonds have had a more decided lower high and lower low, right? You have a high right there, you have a lower high right there. You have a low right there, you have a lower low right there. So that's been a little bit more selling activity as opposed to just back and forth buying and selling to create more of a sideways pattern. This one is a little bit more downward sloping here. And so that was enough to change the intermediate posture to weakly bearish in this case. But on the plus side of the argument, it is still trading above its moving average. So that's why it's not, obviously bearish the way that UUP is. There, not only are you in a series of lower highs and lower lows, but you remain below a falling moving averages as well. So this one, if you had like a really terrible day tomorrow on BNDX, which is what we use to track foreign bonds, and it closes below the moving average, then there's a pretty decent chance you would start to see that background color change to the dark pink shading. But right now, you're kind of giving it a little bit of credit for being above the moving average. And really, it's kind of the same story with oil. Oil looks maybe a little bit better than foreign bonds simply because it's got a rising moving average right now. But same conversation where we've had a pullback in oil prices here over the last week or two, even though it was up 1.7% today. And so that's causing it to give you a heads up that, hey, there's been a little bit more selling pressure in this. And so it has a weakly bearish posture, even if it's not considered strongly bearish yet. If it does break well below that moving average in the next day or two, then expect to see that background color start to change to that dark pink. But for right now, those are just heads up that things are not quite as rosy on those charts as you might find on some of the other charts that are out there. Gold was up 0.36% today, remains with a strongly bullish posture, obviously still above that rising moving average. You did see Treasury yields kind of stabilize today, didn't see a lot of movement there. 10-year Treasury yield ended at 3.52%. It's below its moving average, but the moving average itself is actually rising, so that's why it's colored there in yellow. So you kind of have opposing thought processes there. On the one hand, it's trading below the moving average, but the moving average itself is going higher, and you do have a weekly bullish posture on Treasury yields. Notice the shading of that green in that chart in the lower right-hand corner. It's the only light green shaded chart. All the rest of the green ones are dark shaded. So again, it's kind of the same philosophy as what I just mentioned on oil, which is this is giving you a heads up that there is some stability in the chart to the point where it's giving you some indications that it might want to get bullish, but it's just not full-fledged bullish yet. If it would break above the moving average, there would be a much better chance for that to occur. But right now, we're kind of in a holding position, and of course, the 10-year U.S. Treasury yield is likely to react tomorrow to whatever Jerome Powell says, good or bad. You'll notice that Bitcoin has been holding its gains here. We had that huge breakout the first few weeks of 2023. The last week has been more kind of consolidating sideways, so we haven't seen a resumed breakout. We haven't seen a breakdown. It's really just been traveling sideways. But considering that move so far in 2023, which has been a very, very big move on a percentage basis, the fact that it's even holding those gains, I would say kind of puts that feather in the bullish camp there, right? Again, sector rotation is giving us a feather in the bullish camp. Even all of the broad indices are giving us a feather in the bullish camp. The fact that we've got risk on asset classes like Bitcoin holding up is also a feather in the bullish camp at this moment in time. High yield bonds actually had a very good day. They were up 0.78% today. Pretty strong candle closing near the high of the session. They remain with a strongly bullish posture above a rising 30-day moving average. You will see that foreign stocks have a little bit of a dichotomy here today, or this week, I should say, where we've got the developed foreign stocks actually holding up pretty well, but the emerging foreign stocks have sold off pretty sharply since giving us this overbought cluster signal. Remember, for those of you that are premium members of Market Scholars, we give you access to our 50 plus different customized charts that are out there. In fact, I just put together the newest edition of the dividend stair-step charts. Remember, that particular chart needs to be updated every single year by me because the calculations are done outside of the thinkorswim platform and then are imported back into it. And I need to do that on a rolling 10-year basis. So I generally do that at the beginning of every calendar year. And I just got that finished here earlier today. For those of you that are premium members, I'll have that in your hands by next week. I want to use it myself for a week just to make sure there's no flaws in it and make sure that it's working the way that I want. But assuming that's the case, which I assume right now, I'll have that updated and ready for you guys to import into your own platforms a week from today. But for those of you that are premium members and have access to this particular chart, which is chart 5A, remember, on these 12 grid charts, if you wanted to see the market forecast technical indicator, remember on this 12 grid view, you don't actually see that. The background colors will tell you what the market forecast is doing, but you can't actually see the market forecast itself. It's just the way that the thinkorswim platform works. It kind of hides those indicators if you're trying to look at too many charts at once. So if you ever wanted to see it, you can just right click. So I'm going to go up here to EEM's chart and right click on it, and then go down to maximize sell on the sub menu, and then that blows it up into a much greater screen there for us. And you can see that this little red dot shows up on both the price candle up above and on the indicator down below when you have the green, the blue, and the red lines closing in the upper reversal zone on the same day. Upper reversal zone on the market forecast indicator, by the way, is 80. So, when those readings are 80 or above all on the same day, then you have a red dot that gets plotted. And we refer to that as an overbought cluster signal. Now remember, when we get those, it's not a guarantee that just because something is overbought that it won't stay overbought, right? But this is a good example of why it is at least important to consider those overbought cluster signals, because as you can see, that was plotted exactly on the highest day for EEM over the last 3 months. We wouldn't have necessarily known it that day. In other words, we knew that there was a cluster, but we didn't know that the next day that it would fall, right? All we knew is that that was day one of the overbought signal. Well, wouldn't you know, the last 3 days, you've actually seen EEM fall all 3 of those days when the stock market was extremely bullish today. So, that's really saying something, that the emerging markets were down today by 0.22% when the S&P 500 roared higher by nearly 1.5%. And one thing that came out here earlier this week, in fact, I think it was yesterday, there was a rumor or a news story coming out of China that suggested that Alibaba was thinking about moving their headquarters over to Singapore. Now, they came out and denied that, but it does make you wonder if the whole reason that a lot of the Chinese stocks have been down so viciously so far this week is because of that, because there's an expectation that the Chinese government would not allow Alibaba to do that, even if they attempted to do it, and there might be some pain to pay for that entire category of stock. So I think there has been a little bit of a limitation in what had been a very robust rally out of the emerging markets, simply because of what we heard out of the tech sector in China specifically here this week. Remember, EEM is not China specific. It's broad-based emerging markets, but China is by far and away the most important country within the emerging markets. So a company like Alibaba, which is one of the most important companies within one of the most important countries within this ETF, can have a considerable impact. And I think that's part of what we're seeing here the last 3 days. It's obviously still in an uptrend, but a little bit of a disappointment in the last 3 days when you know that other markets around the world have been rallying so furiously. Let's go ahead and take a look at our sectors now, and we will use chart 5C for that conversation. So in this case, you can see that we have mostly green charts here in the United States. The exceptions to that are healthcare and utilities with the darker shading of pink. And of course, remember, those were 2 out of the bottom 3 on the sector selector tool I just showed you a moment ago, telling us that there is more wear and tear, both from a market cap weighted perspective like we're looking at here in front of us, and also on an equal weighted perspective like we were looking at on the sector selector tool. So either way, it's telling us that the defensive areas are out of favor on a relative basis versus some of the more growth-oriented areas out there. Energy has a light pink chart telling us that it's weakly bearish, but not strongly bearish like utilities and healthcare are. Otherwise, it's pretty strong out there, right? You have a lot of very aggressively bullish charts out there. You saw that financials, as just one example, broke to new closing highs today in the market cap weighted version, at least, with XLF basically at new 3-month closing highs today. You saw that communications is up there near its 3-month highs that it just plotted here a week ago. Technology's got a little bit of work to do. They would have to break up and through this area in mid-December, so we're not quite there yet. But discretionary is at a new closing high, similar to the financials. Industrials is experiencing a pretty nice bounce here today, despite the bad performance out of Caterpillar. Enough of the other industrials were up quite a bit that you're up there close to 3-month highs. And then materials is at a new 3-month high as well on a closing price basis. And last but not least, sneaky little the REITs, the real estate sector down below here, which is oftentimes defensive and had been out of favor just a couple of months ago in late December. They were an underperformer, but unlike some of the other interest rate sensitive areas like utilities that have rolled over since then, real estate has actually started to pick up its pace. And all of a sudden we find the REITs at 3-month highs here. Those of you that are in my dividend growth investing class know that the REITs were our biggest position that we put together in last semester's portfolio. In other words, the areas that are most out of favor attract us as dividend growth investors. And so as REITs have now broken to 3-month highs, that portfolio that we put together just last semester is doing quite well as a result, right? I think we ended up having 5 out of our 25 positions in just that one sector. And so that's a really nice surprise there, because otherwise, the staples and some of those other dividend-oriented areas are doing a little bit more poorly, but the REITs are definitely carrying their water for our portfolio there. So a great move there out of the REITs yet again today, up 1.83%. Hanging in there with some of the bigger performers. So all of our sectors were up, by the way, today. It's fairly a rare day when we see that. The worst performer was utilities, up only 0.74%. And then the biggest performer to the upside probably would have been discretionary. It was up 2.29% today. And remember, we've already known that discretionary has been number one on the sector selector for the last 3 weeks. And so this should not have come as a surprise. We should be prepared for it to be the leading area, which it was yet again here today. All right, let's get into our trade application example now. And for those of you that are premium members, you'll know that the trade has already been done, as is typically the case. I will do the trade itself while the market is open, and then I'll take the screenshots of our trade confirmations and fill prices and all that kind of stuff to put into our Telegram alerts app for those of you that are premium members, to give you an added perk for being a member of our organization, as opposed to everybody else that just watches these free videos at night. They can't place their trades in many cases until the following day, and sometimes the market has moved considerably the following day. So sometimes it's the opposite as well. We'll never know, but at least we'll give you an informational edge by letting you know what we're trading before the market closes, even though we do these video recordings after the market is then closed. So what I chose today for our trade application example was an iron condor. But I will tell you, part of the reason I selected that in the end is because I didn't necessarily want to get too directional immediately in front of the FOMC meeting tomorrow. There were a couple of other trades that, had I decided I wanted to be really bullish, the chart that I liked there was Mobileye. This is a spin-off that ended up doing an IPO, but it was spun off from Intel. And a lot of people might not be aware that this stock is now a standalone publicly traded company once again. It used to be, and then Intel bought them a few years ago and now has, spun them off as a separate company again. And this IPO has been a rare IPO in the year 2022 to begin with. Remember, very few IPOs were happening, and this one has been doing really well. It is at a new closing high in its kind of second round as a publicly traded company here. It was up about 6% today. So if I were to do a bullish trade, that was one that caught my eye. On the flip side, if I were to do a bearish trade, one that caught my eye was Futu. This is one of those Chinese companies that I had mentioned that is selling off in the last 3 days, and you can see that it went right up to its downward trending 30-day moving average and now has been rolling over underneath of it for the last 3 days here. So if I were to do a more directional bearish trade, this is one that I had my eyes set on. But instead what I settled for was an iron condor, which is non-directional. And for that I chose ACN. This is Accenture. And this is a company, as you can see, is kind of trading right here in the middle of its range that it's had for the last 3 months right here today. It was up today with the rest of the market, but you can see it's nowhere near its high from back here on December 1st, and it's nowhere near its low from over here on December 20th. It's kind of in the middle of those two ranges. And you can see here with my different blue lines, the top one and the bottom one, where my break-even points are on this iron condor trade. This is the month of March that I selected, by the way. And on the top side, on the call side, I sold a 305, 310 bear call spread. And on the bottom side, I sold a 255, 250 put spread. And I collected $1.20 for selling that iron condor, so my break-even points would be 306.20 and 253.80. And for those of you that are newer to the idea of iron condors, what I want to have happen in this case is for this stock to stay between those two lines. And if it does, then I will make money on this trade. On the other hand, if it has a big break higher above this top line or a big break lower below this bottom line, then I'll end up losing money on the trade. So what I'm hoping for here is a lack of direction as opposed to a big move in one direction or another. And what I really liked about this setup is that it allowed me, with a rational and reasonable return possibility, I got about a 30% return on risk on this one, which is oftentimes what I shoot for on my credit spreads. And yet I was able to give myself enough flexibility in the trade where basically I'm bracketing the high and the low of this stock over the last 3 months. My break-evens up here at 306 are just a hair above the 305.13 high point, and on the bottom side, my break-even of 253.80 is basically right there at the low of 253.50 back here in mid-December. So as long as you don't have a big breakout above its 3-month high or a big break below its 3-month low, then this should end up being a winning trade. Okay, so that's what I ended up doing today, a non-directional trade intentionally, because I didn't want to get too directional right in front of a big announcement like the FOMC tomorrow, where there could be a big swing in one direction or another. So we'll kind of reevaluate that at the time, and I'm sure David will be back with you tomorrow night for his video at that time, and then I'll plan on being back with you on Thursday with another video. If you want me to do another long form video like this hour-long one with another trade application example, click like for me there on Twitter. As long as we're up and over 100 likes, I'll be happy to do that for you. On the other hand, if you'd prefer me to do just a 15-minute stock market recap with no trade applications or 12 grid analysis, then don't click like. And if we're under 100 likes on Twitter, I'll just make sure it's a nice quick one there for you on Thursday. So we'll let you guys decide there collectively. Whatever you do decide, regardless, I appreciate you checking this video out tonight. I will hope that all of you go into tomorrow's FOMC announcement with lots of flexibility in your trading, and may the trading gods be in your favor. It should be a fun one as always. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.